Hey there, welcome to part 2 on this 3-part video series where I go over investment accounts. Today's topic is retirement accounts. This one's going to be info-packed. So if you're not already sure what an investment account is, then please check out the link in the description to my part 1 video where I go over the basics to investment accounts there. Assuming you've already seen it, then let's jump into retirement accounts, because retirement accounts can be super powerful. I'm sure at one point or another you heard someone mention the phrase, max out your 401k. Or maybe you heard someone talk about how great it is to open up a Roth IRA. But what are those things? What does that even mean? So today, I'll be talking about the must-knows when it comes to retirement accounts and how everyone should have at least one of these accounts open, if not every type. Welcome to Finance for Everyday People. I'm Jeff Moore, where I teach you all about your personal finances the way you should have been taught. So coming off my last video where I talked about taxable brokerage accounts, in this video I'll be talking about retirement accounts, specifically 4 different types that you can get. As we go over these types, I want you to keep in mind 3 different things. First is functionality, like how the account works. Second is taxes, because when it comes to retirement accounts, taxes can be especially tricky. And third are the restrictions. As you can imagine, these are retirement accounts. So the biggest restriction is that you can't take out any of this money until you reach retirement age. And before we dive into the different types, let's go over some vocabulary words to really get these points across. Contributions are just exactly what you might think. They're just regular payments you make into said retirement account. In the context of contributions, there's pre-tax and after-tax. See, pre-tax just means money that you've contributed into your retirement account before you've paid income tax on it. After tax is the opposite, meaning income tax has already been removed and this is your hard-earned cash being placed into your retirement account. The easiest way to think about this is if you're working a 9-to-5 job and receive regular paychecks, you can see that in your pay slip, there's actually a section that tells you how much taxes are being withheld. So whatever money you're taking home, that hard-earned cash is your after-tax income. A good example of pre-tax income is if you're self-employed or a contractor, and every paycheck you get, you typically take home the full pay. However, when it comes to due taxes during the next tax season, you then have to go back and pay on whatever income you earned. So now that we understand that, let's go ahead and jump into these retirement account types. Starting off with traditional individual retirement accounts, or as most people call them, traditional IRAs. It's best to think about traditional IRAs just like you would a regular taxable brokerage account. It's the same idea where you put money into an account and then use that money to buy and sell investments. Now, traditional IRAs use pre-tax money. But wait, how is it pre-tax money if in my paychecks, taxes are already being withheld and I'm using my hard-earned after-tax income to contribute into this IRA? And the answer is you can actually get some of that money back. See, if let's say you've contributed $5,000 to your traditional IRA, then what happens during tax season is when you do your taxes and let's say you've earned $100,000 for the year, well, what you can actually do is subtract off that $5,000 from your taxable income, meaning you've only technically earned $95,000. What happens to that $5,000 you contributed? Well, any taxes you paid on it actually gets refunded to you in your tax return. So even though you're contributing to your IRA with after-tax dollars, you get this tax break where you get more money back on your tax return so that it equates to contributing pre-tax dollars. If the talk about taxes confuses you, then please check out the description. I'll leave a link to my video on taxes, income, and capital gains so you can understand more about how this all works. So the biggest advantage with traditional IRAs are the fact that you get that tax break today. As you contribute each year you can then file that deduction and then get that bigger tax return. However, that doesn't mean you're free from taxes entirely. When you do retire and it comes time to withdraw some of that money, you then have to pay taxes on anything you withdraw. In this example, where you've been contributing $5,000 a year for 30 years, then you have $150,000 in total contributions, plus any gains, let's say $150,000. Doesn't matter what you're withdrawing, everything you withdraw is going to be subject to income tax. When it comes to the restrictions with a traditional IRA, the first one is the fact that you can't withdraw any money before turning 59 and a half, or as you can say, retirement age. And if you do, you're subject to paying penalty fees on top of any taxes. Another thing to watch out for is the annual contribution limit. See, each year you're only allowed to contribute a certain amount into your IRA. For 2026, it's $7,500. Every few years, the limits do change, but only by a few hundred or so. This is typically the range that it's at. The biggest thing to keep in mind with these restrictions is that because you're getting this tax advantage, you can only do so to a certain extent. Next up, we have Roth IRAs. And similar to a traditional IRA, it's just a regular brokerage account you use to deposit money in, go ahead and trade investments, and you can only withdraw the money for retirement. Now, the biggest advantage with Roth IRAs are actually how taxes are handled. See, with a traditional IRA, we technically use pre-tax money to contribute into it. However, with a Roth IRA, these are after-tax money. The biggest payoff comes when you're at retirement age and it's time to start withdrawing. Any contributions and gains you've made while this account was open is completely withdrawable tax-free. So it's like the opposite of a traditional IRA in the sense that you're taking the penalty today. You're paying regular taxes on what you're contributing. However, that money stays, grows, and when it comes to retirement, you can take it out at no fee. This is why Roth IRAs are considered some of the most powerful accounts to date, because the gains you make in, let's say, a 30-year period is ridiculous, and you pay no taxes at all when you withdraw it. That money is completely yours just because you're willing to sacrifice years of minor tax deductions. When it comes to the restrictions on a Roth IRA, it's almost just like a traditional IRA. You can't withdraw anything before turning 59 and a half, otherwise you have to pay some penalty fees. And there is still the annual contribution limit. For 2026, it's again $7,500, unless you're closer to retirement age where you are allowed to contribute slightly more. The biggest restriction with Roth IRAs, because they're so powerful, is the income limit. If you exceed a certain amount of income each year, then you're not allowed to contribute the full amount into an IRA. And if you make too much in 1 year, then you can't contribute anything at all. Even so, there are backdoor methods to having a Roth IRA, even if your income exceeds the limit. But I won't cover that here just because I want to introduce these account types, and I can dedicate a whole video to Roth IRAs alone. Putting the two IRA types side by side, we see the benefit of withdrawing tax-free gains with the Roth IRA versus the traditional IRA, but it goes a layer deeper. Chances are you'll be in a higher tax bracket 30 years in the future than you are today, simply because for most people, income goes up with time. So if your choices are pay taxes now at a lower bracket instead of paying taxes later when you're in a higher bracket, the smarter choice is to opt for the former. Just another reason why Roth IRAs are so well liked. Next up are 401ks, and these are employer sponsored, so they're not your typical brokerage accounts. And what they're offering isn't just an account you can open up and then buy and sell what you please. It's actually more of a prefixed menu of investment options. Whatever you do choose, however, ultimately does consist of individual stocks and ETFs. You just can't see them. What makes a 401k so popular is the fact that a lot of employers offer a matchback, meaning if you contribute, say, 6% of your paycheck, then your employer will give you that same amount of money into the account. Now, that was just one example. The exact matchback that your employer contributes is dependent on your employer's plan. So when people say maxing out your 401k, what that means is contributing enough of your regular paychecks to the point where your employer contributes the max amount they're able to. An example might be your employer contributes up to 4%. then what that means is 4% of your regular paychecks, say that's $200. If you contribute $200 to your 401k, then your employer throws in another $200 for you. It's because of that match back that you should always be maxing out your 401k, because it's just free money and you don't want to leave it on the table. And when it comes to taxes, the amount you're contributing is technically pre-tax. See, you typically see it in your payslip before taxes get withheld that money is going into this 401k. And then similar to a traditional IRA, once money starts being withdrawn from this account, then you start getting hit with the taxes. For the restrictions, just like all the other ones, you can't withdraw before turning 59 and a half, and the annual contribution limit for 2026, it happens to be $24,500, but again, every few years or so, that amount goes up by a few $100s. The biggest difference between 401ks and the IRAs are the fact that you can't just go into a brokerage firm and open up a 401k. This one is specifically employer offered. So you can't open up your own account. You have to be employed through someone who offers it. And actually, there's a Roth 401k now, which similar to the traditional versus Roth IRAs, the only difference between a traditional and a Roth 401k is that it's after tax dollars. So when it comes time to withdraw, same thing applies. You can get those gains and contributions you made tax-free. And on the topic of employer benefits, there's one more account type that I'm just going to touch upon without going too deep into it, and that's pensions. Pensions are a lot less common nowadays, but they are employer-funded income for when you retire. See, these are investments owned by the company, and then when you retire, you get paid out either a lump sum or even a regular salary for the rest of your life. The amount of money going into your pension fund is dependent on how long you've worked there. So the longer you work at a company that offers this benefit, the more and more you'll receive at retirement. What you receive is taxed like ordinary income, and the withdrawal terms differ depending on your specific employer's plan. If we're talking about free money, pensions are literally that, since you contribute absolutely nothing. However, it is only for retirement and very limited in today's day and age. That concludes this video. I know that was a lot of information, so please go back, pause, and digest some of those illustrations and definitions, because retirement accounts, again, are super crucial for you to know, and I highly suggest you open up one today if possible. If anything was unclear, please leave some comments down below, and I'll be sure to get to it as soon as I can. But as always, if you enjoyed this content, please drop a like, subscribe, share with someone who needs to hear it, and be on the lookout for part 3, where we go over some of the other less common investment accounts. But until then, I'll see you next time.